Oops, did I lose everyone? Okay, sorry. Thank you. My name is Michael Matheson. I'm an equity analyst with Sidoti. Today, we're pleased to have with us the team from Gold Royalty Corporation. Before I introduce them, just a couple housekeeping things. We really encourage questions and participation. So to ask a question, you'll see at the bottom of your screen a little box that says More with three dots. Click the box and it will offer you a Q&A screen. Type in your question and we'll read them out toward the end of the presentation, where we've reserved about 10 minutes for questions. So again, Gold Royalty Corporation presenting today will be David Garofalo, CEO. David, please take it away.
Well, good afternoon and good morning, as the case may be, everybody. Thank you for joining us today. Just in terms of some basic facts, Gold Royalty is traded on NYSE American under the trading symbol GROY. We also have some warrants outstanding as well. They mature in May of 2027. They trade under the same symbol with the .W suffix if you're looking for another way with a bit more torque to play the name. Gold Royalty Corp was founded 5 years ago. Privately, we took it public on the NYSE American in March of 2021, initially with 18 royalties that were written on the underlying gold development assets of our former parent company, Gold Mining Inc., spun out raising $90 million US on the NYSE American at a price at that time of $5 per share. The stock went to $7 shortly after the IPO. Recognizing that we had a very strong multiple, particularly relative to our competitors, we initially pursued a roll-up strategy that allowed us to significantly diversify our royalty portfolio. We bought 3 companies in the course of 9 months, all similar in size to us. So effectively added about 150 royalties into the portfolio as a result of those acquisitions, and meaningfully brought in some cash flowing royalties into the portfolio to supplement the significant mineral endowment we had in the royalties on the underlying assets that were spun out of Gold Mining Inc. So today we're at about 250 royalties in the portfolio, 7 of them cash flowing, 14 in various stages of development and construction. And that gives us peer leading revenue growth and geo growth, gold equivalent ounce growth of 360% over the next 5 years from the existing portfolio of 250 royalties, which I hasten to add are completely bought and paid for. We have no installment payments. We have no capital calls. So as these assets are built out, optimized, expanded, explored, we get the full benefit of that upside, but it's completely done off the balance sheet of our operating partners. So we have no requirements to put any more additional capital to realize that growth. And that will entail significant free cash flow generation. And in fact, this is the first year of positive free cash flow in our history. So we've gone from a startup, a concept 5 years ago, literally on the back of a napkin at a cafe, to one where we have 250 royalties and we're growing to almost 30,000 ounces of gold equivalent production by the end of the decade against a very low operating cost base. And maybe that'll just allow me to spend a couple of minutes talking about the royalty model for those that are not familiar with it. And maybe Jackie will just skip back to the introduction slide for a moment and I'll talk about a little bit about our portfolio. But effectively what a royalty company is we own exposure through the top line of a mine. So effectively, we're providing capital to the developers, the explorers, the operators to help them build and optimize and explore their mines and their deposits. And we take a royalty, a gross revenue royalty back in return. So we get a percentage of the top line. What that effectively allows us to do is realize the full upside in the gold price unmitigated by inflation. So we have no exposure to the operating costs at a mine site. We have full exposure to the gold price upside, and any upside they realize and any expansions they undertake in their operations or any exploration they undertake on their properties over the course of the mine's life. So our royalties run with the land, they run with the property. They cannot be divided, they cannot be diluted, nor can they be mitigated by operating cost inflation, which is an important differentiator from an operating company. Operating companies obviously have full upside to the exploration that they realize on their properties and the expansions, but what they're mitigated by is inflation in their operating capital costs. We have no such exposure in our model. We're effectively a bank singularly focused on providing capital to the operators and taking a piece of the action back, if you will, in the form of a percentage of the top line of the revenue. So that's an important distinction. And again, once we own the royalty, we own it forever. It's perpetual. It runs with the land. It can't be divided. It can't be diluted. So we really have unmitigated and infinite optionality on the exploration and the gold price upside of those properties that we have royalties on. And we have 250 royalties in the portfolio, so we're very, very well diversified. And that's another key distinction of a royalty company relative to an operating company is there's no limit to how much we can diversify. We could run a company 10 times the size with the same human footprint we have today. We have a little over a dozen employees, and we could, again, run a portfolio of 2,500 royalties if we wanted to with the same number of people. We've added nobody to the organization really since the IPO, other than maybe one person, and effectively have scaled up the business with the same human footprint. So our G&A costs have remained flat. We have no operating costs other than the cost of running a public company with a small group of executives. With a small group of executives that I should hasten to add have significant industry experience. I've spent 35 years in the gold mining industry and base metal. I ran Gold Corp, which we merged with Newmont back in 2019. At the time, was the third biggest gold company in the world. I ran Hudbay on the copper side. Before that was the CFO of Agnico Eagle, which today is the biggest gold mining company in the world. So I come from a development and operations background, and that's a recurring theme within our management and board. We have collectively within our very small management and board, less than 20 people collectively, 400 years of industry experience. And importantly, industry experience on the development and operations side. And that's unique among the royalty universe. Virtually all the royalty companies, our peers in the space, are run by financial engineers. We're run by people that have actually built and operated mines, which gives us two distinct advantages. One is we have a clear-eyed view of the underlying risk of what's being built and operated, so we can evaluate that risk readily and price that risk appropriately within the return proposition that we're looking for in royalties we're investing in. But also it gives us tremendous connectivity because, like myself, many of my board of management have come from large cap producers. And so there isn't anybody in the industry that we can't pick up the phone and talk to in order to get at an opportunity before our peers are even aware of it. That's why we've been able to grow this portfolio so quickly and so in such a diversified fashion. And we've done it on a bilateral basis at each and every one of the acquisitions we've made. So in other words, we didn't have competitors, so we were able to price the risk appropriately and get a very strong rate of return for our shareholders. And the other reason we've been able to do that as well is because we have diverse growth platforms. We have 4 of them, in fact. There are really only 4 ways to grow in the royalty business, and we do all of them extremely well. We've done M&A exceedingly well when we had the currency to do so. As I said, we rolled up 3 of our competitors over the course of 2021 in 9 short months, when our currency just simply wasn't there anymore because of the derating we experienced in the gold sector from 2022 onwards. We focused on other ways to grow. We had $90 million in our treasury from the IPO. We started acquiring royalties from third parties who were looking to monetize royalties that they already established. We did royalty financings where we provided project financing for construction of mines so that those mines could be built, and we got a royalty back in return. And we also generate royalties organically. And what that means is with a very small team in Nevada and Quebec and Ontario, we stake exploration claims. In other words, we stake properties around existing mines and deposit. That's done for virtually no cost. And then we vend those properties to the neighboring operators who then conduct the exploration and mine development on their balance sheet and take a royalty back in return. So through our sweat equity, about a third of the royalties we have in our portfolio, over 70 of them, were generated for free. Not only do we get those royalties for free, we often get option payments on the properties from the operators, and we get about $3 to $4 million of option revenue per annum over and above our royalty revenue, and that largely defrays our G&A costs. About 50% of our G&A costs are covered from this royalty generator model. So not only are we generating these royalties for free, we're getting paid to generate these royalties because of the expertise we have on the ground in those key jurisdictions, Nevada, Quebec, and Ontario. So what this all means in terms of our growth, maybe we can go to the next slide, Jackie, is that, and I am skipping around a little bit, is we're going from about 6,000 gold equivalent ounces of production this year to almost 30,000 ounces of gold equivalent production by the end of the year. Those are ounces attributable to us by virtue of our royalties. And they're coming from some of the largest scale mines in North America. We have royalties on three of the five biggest producing gold mines in North America, namely Agnico Eagle's Canadian Malartic mine in northwestern Quebec, IAMGOLD's Côté mine in northern Ontario, which represent two of the largest three operating mines in Canada. And we also have a royalty on the underground extension of Goldstrike, which is the largest producing gold mine in the US, operated by Barrick and Newmont in Nevada. So not only do we have this collection of diverse assets within those key jurisdictions, but we have some foundational assets with multiple decades of reserve life ahead of them that represent annuities that will be paying our shareholders for decades to come. And that's, again, another key distinction relative to our peers in that we have high quality assets in some of the best jurisdictions of the world with the best capitalized operators, which is extremely important. You want to make sure that you have operators that have the balance sheet and the technical capacity to optimize their operations, both from an exploration and operations and development standpoint. You want those key operators, and we certainly have not only a diversity of assets, but diversity of operators with well-capitalized balance sheets to optimize their assets over the course of time. What this translates to in terms of cash flow is dramatic cash flow growth over the course of the next 5 years from the growth profile that I outlined a little earlier on. So we're going again from, you can see in the yellow bars, those are the volumes. We're going from about 6,000 ounces of gold equivalent in 2025 to close to 30,000 ounces of gold equivalent by 2029. Those I-beams there that you see in blue represent our guidance. The yellow actually represents the consensus estimates of our 6 analysts that cover us across the space. So we've overlaid our own production guidance, which is a little bit higher because there's been a number of expansions that have been announced on a number of these assets recently that the sell-side community has not had an opportunity to incorporate into their models yet, but I'm sure they will, and they'll catch up in terms of our own estimates of guidance. But if you overlay a gold price assumption on those volumes, that's what those line graphs represent. We've overlaid our revenue estimates on that volume. It's simple arithmetic. That volume multiplied by the gold price. Pick your assumption. We've laid out $2,400 to $3,600 an ounce range, and so that brings us upwards at current gold prices close to $90 million of revenue by the end of the decade. Our G&A costs are $7 to $8 million per annum. And not only are they flat, they've actually come down over the last several years as we've realized synergies from the companies we've absorbed. We actually took $10 million of annual G&A out of the system by absorbing 3 of our competitors and completely absorbing their portfolio without absorbing any of the human resource costs of running those companies, and obviously defrayed all of their listing costs and other public company costs by absorbing the companies and singularly focusing them within the company Gold Royalty Corp. So in other words, every dollar of incremental revenue growth goes right to the bottom line in terms of free cash flow generation. So what kind of multiple do you apply to that? Well, by the end of the decade, we're looking at close to 90% margins in our business, $80 million of revenue, of free cash flow, I should say, at current gold prices. Even if you apply to a 20 times multiple to that, which I think is reasonable for free cash flow multiples, you're looking at nearly a tripling in our share price just on that simple arithmetic. And the other opportunity is get a re-rate within our stock over and above applying a cash flow multiple or free cash flow multiple. If you look at the multiples and a price and net asset value that royalty companies typically trade out, they're vastly superior to the producers in the space because of the low underlying risk of our business, the diversification I mentioned earlier on, the fact that we don't have inflation risk, the fact that we have scalability, the fact that we have a much higher margin business than the producers have. Typically means that the seniors in our sector, Franco-Nevada, Wheaton, and Royal Gold, are typically trading at 2 to 3 times the underlying net asset value of their business. The smaller cap players are typically trading at 1 times because they don't have the scale the seniors have. But as you can see, given that all of our royalties are completely bought and paid for, we're going to achieve significant scale organically over the course of the next 5 years. And there's no reason we can't realize a significant re-rate in our multiple on a price and net asset value basis commensurate with what we're seeing in the seniors because we're attaining that scale organically with the existing royalty portfolio. And I would put up our assets, our key cornerstone assets, namely the 3 of the top 5 in producing gold mines in North America, up against any of the assets that the seniors have in our sector. So we have quality, we have low political risk, and we have embedded, completely bought for growth within the portfolio. And the other added dimension that's occurring in the space is consolidation. There's been significant consolidation among the royalty players. Most recently, Royal Gold announced the acquisition of Sandstorm. You can see both of them are on this graph. Sandstorm will disappear in the coming weeks. And Elliott owns the majority of Triple Flag, and they also have taken a significant stake in Osisko Royalties. I expect they will probably catalyze some further consolidation among that mid-tier, which means that $1 to $10 billion market cap universe will be completely vacant if that occurs. And that's an opportunity among the smaller cap players to create the next mid-tier champion, to capture the attention of the market, get in that Goldilocks zone where you're big enough to be institutionally relevant to generalist investors, but still small enough to grow. Because as good as those senior companies are that get those superior multiples, they're great companies, blue chip portfolios, great cash flow. But what they don't have is growth because they're too big. So if we can offer that mid-tier, as I said, Goldilocks company in that $1 to $10 billion market cap universe, which will be left vacant with the consolidation that's currently underway, we think we can actually capture a multiple superior to the seniors because we can offer both liquidity for investors, but growth. And that stands us in stark contrast to the seniors in the space by offering that growth that they certainly can't offer. Jackie, maybe we can go to the pipeline and I can talk in a little bit more detail about the pipeline that we have. As I said, we have 7 cash flowing royalties. We have 14 in various stages of construction and development to provide that underpinning of growth of 360% growth in revenue in gold equivalent ounces, I should say, over the next 5 years. Obviously, unmitigated leverage to the gold price. So if you believe in gold price fundamentals and the potential for the gold price to continue to go up, we offer that unmitigated leverage both to the gold price and exploration. We have another 40 plus royalties in the advanced exploration stage, which are assets that actually have defined resources on them. And then we have pre-exploration stage or pre-resource stage assets, over 180 of those within the portfolio that provide optionality in good geological districts. Over 80% of our portfolio, again, is in Nevada, Quebec, and Ontario by number and value, which are perennially rated among the top 5 jurisdictions in the world for mineral potential, low political risk, and low regulatory risk. So we have a very heavy concentration of assets within those key jurisdictions. And we really are a pure gold play. If you look at our metal exposure, we're over 90% gold when you look at it as a percentage of our overall book value. And jurisdictionally, as I said, we're the heavy concentration in Canada and the US, where you have low regulatory risk and low permitting risk, but also important rule of law. Because at the end of the day, a royalty company is just a collection of contracts. So we're very particular about what jurisdictions we're in. We want to make sure we're in jurisdictions where we can enforce our contracts if we need to through the judicial system. And from time to time that happens. You have to be able to enforce those contracts. And I can tell you when we've been successful every time because we've been in jurisdictions that recognizes the sanctity of our contracts. And as you can see, we're very much oriented towards cash flowing and near cash flowing assets in terms of the underlying value of our business, but with significant free optionality in terms of those early stage royalties that we have. Since there are no holding costs of royalties, that optionality is infinite. We'll just hold on to those royalties forever, even if they're early stage, because they're in good jurisdictions near existing mines with strong, well-capitalized operators that can bring those royalties into fruition in very short order with the infrastructure they already have in place. Maybe just to provide you an overview of our trading, our capital structure, I think to end there before I open it up for questions. I've talked about some of our key assets, but as you can see here, we're well covered on the south side. We have 6 analysts that cover us with a median target price of about $3.50 per share. That's actually come up quite significantly recently with both the gold price appreciation, but also because we are in that inflection point. That free cash flow that I talked about is being crystallized as we speak. The first 6 months of this year was our first period of positive free cash flow in our history. And as you saw earlier on, that's expected to grow exponentially over the coming months just by volume. Absent any increase in the gold price, we expect through the volume of production, and over 80% of that growth is already built out and being ramped up. So it's very low risk from the standpoint of development risk and construction risk. So a lot of that construction risk is behind us. So we expect that that'll result in significant share price appreciation, as I outlined a little earlier on in the presentation. We're a very liquid stock. Again, we trade exclusively on NYSE American, in spite of the fact that we are a Canadian company, but we trade over 2 million shares a day. So current share prices, that would be north of $6 million of trading liquidity per day. That equates to about 90 days to turn our market cap. So for a relatively small cap company, we're extremely liquid. So that means you can build positions quickly. And then when you're looking to crystallize the gains that you've realized, as many of our shareholders have recently, then you can do so quite readily given the trading liquidity. We have very little debt on the balance sheet. We've drawn $27 million out of a $75 million line of credit that we have in place with Bank of Montreal and National Bank Financial. That's a 3-year line of credit that doesn't mature until 2028. And it's been an evergreen facility that we've continually extended, added on a year each and every year. So it's always been a 3-year facility. We do have a convertible debenture outstanding of $40 million, but that convertible is well in the money. We actually can force conversion in November of 2026. And given that it is in the money, we'll likely convert that, which means by the end of 2026, we expect to be completely debt-free as a result of the free cash flow generation we have and the conversion of those convertible debentures, which means that all of that cash flow growth is completely unmitigated by any carrying costs on our debt by the end of 2026. So it's a well-capitalized company in great jurisdictions with great assets, great operating partners, and unmitigated exposure to both the gold price and the exploration being conducted by our operating partners. Again, over $200 million of exploration being conducted on the underlying properties by our operating partners, completely off of their balance sheet. We get the full benefit of that upside without actually having to pay for it because all of our royalties are completely bought and paid for. That means that growth that I outlined is free growth without any capital burden whatsoever going forward. So that's, Michael, the story, and hopefully this leaves enough time for some Q&A from your kind listeners today.
Well, terrific. In fact, we did get a lot of questions. So let me see if I can organize a few of them. I think the place that makes sense to begin is just with the growth of your current portfolio in terms of its production of gold. If I understood the chart right, we're looking at a roughly 5 times increase in gold ounces produced just with no changes in the portfolio. That's just the mines you have and their growth, right?
That's correct. So it's coming from mines that, as I said, over 80% of them are built, and they're just ramping up to full production. And that's true, for example, in the case of Côté, which is Canada's second biggest producing gold mine, just started production last year, just ramping up to full capacity, and has already announced an expansion of production beyond what we had discounted in our valuation of that royalty when we bought it. Similarly, Canadian Malartic, which is operated by my old company, Agnico Eagle, is undertaking a $1.6 billion expansion of the existing operation that's been in production since 2011. So that is largely built out as well, and they're ramping up the underground as they convert from an open pit to underground operation. Similarly, Ren, which is an underground extension of Goldstrike, Barrick's key asset in Nevada, that they're ramping into the deposit as we speak. It's a low capital intensity, only a $400 million expansion. They've already spent about a third of the capital on that, and they expect to be in production as early as next year. Again, well-capitalized operators, good jurisdictions, infrastructure already in place in terms of not only road infrastructure, power, but also existing plants. So they don't have to build a new surface plant. They're just leveraging the infrastructure, the industrial complex they already have in place. So this is very low intensity, capital intensity, low risk growth that we have in the portfolio, already bought and paid for within our portfolio, delivering these volume of ounces. And that does not take into consideration expansions that they're already considering on these assets, because as they build out the infrastructure to operate these mines, they also get infrastructure to drill these deposits from underground. That affords them better access to look for brownfield opportunities for expanding the geological resource. And those expansions will ultimately and inevitably lead to expansions in production, which are not factored into our production volume. So we see these production volumes as really the floor, not the ceiling.
Okay, terrific. So the second place where I see potential valuation increases is just the leverage that you have to the price of gold. So obviously gold prices are volatile. They can go down as well as up. But if you could just kind of walk us through, if gold prices took another 10% increase in price, what would that mean to the NPV of Gold Royalty?
So in rough dollar terms, so every $10 increase in the gold price by the end of the decade would equal, at 30,000 gold equivalent ounces would equal $300,000 of incremental revenue. It would fall right to the bottom line. So in really, I'm just using round terms. We're not quite at 30,000 ounces, but very close to it. But just for illustration purposes, that's the kind of leverage we offer on a $10 increase in the gold price. So you're right, gold prices are volatile, but I would say over a 50-year horizon, it's been a one-way trade. You look at what's happened to the gold price since we abandoned the gold standard in the early 1970s. Gold's gone from $35 an ounce to $3,500 an ounce. So a hundredfold increase in the gold price. And what's happened to the purchasing power of the US dollar, and for example, for that matter, any fiat currency globally, purchasing power has gone down about 99% over that period of time. It's a very linear relationship. So certainly, yes, there's a lot of volatility in the interim in the gold price because it's a freely trading commodity and there's a lot of buyers and sellers. That's the definition of a true liquid commodity like gold. But over a long time horizon, gold has gone in only one direction. And I would argue that we're just beginning, because if you look at the debt burden we've taken on globally as governments, as businesses, as individuals, that's grown exponentially since the last time we saw a big gold run in the 1970s when we last had an inflation cycle. The global debt to GDP is now 350%. Back in the 70s, it was only 100%. What that tells you is the Federal Reserve, and for that matter, central banks globally, have very limited latitude to raise interest rates to deal with inflation. They're going to have to let it ride. They're going to have to continue to expand money supply as they have been unabated since the great financial crisis in 2008, and will continue to do so because there's no fiscally responsible way to repay that debt. They have to inflate it away. And so the purchasing power of fiat currencies will continue to be degraded, and gold is the one currency that can't be printed. And in fact, there's a remarkable inelasticity of gold supply to price because reserves in the ground among the producers globally have gone down 40% in the last 12 years because the industry has not had access to general equity markets. So they haven't had the capital to replace depleting reserves. They haven't conducted the necessary exploration. So it's become an existential crisis for the producers who've had to consolidate with each other to sustain unsustainable production levels. What that means is the big guys in our producer universe have done nothing but grow their share count over the last 30 years. They haven't grown production and reserves.
Okay. Well, it's interesting. Just one more question, or perhaps two, before we will need to close out. But you have all that revenue growth in your forecast. You just hit positive cash flow. We would assume it would get larger going forward. Would you think that you might be returning some of that cash to shareholders at some point, or what are your plans?
No, it's an excellent question. So as I said earlier on, we expect to be completely debt-free by the end of next year, given our free cash flow generation, the fact that our convertibles, even our warrants, are well in the money as well. So we're in a position to actually have a very well-capitalized balance sheet by the end of next year and return capital to shareholders in various forms, whether it's a share buyback if our valuation continues to be depressed as it is now, or looking at returns of capital in the form of dividends. At the end of the day, this is a collection of annuities. Why wouldn't we share that annuity with shareholders?
Makes sense. Just again, kind of thinking about the big picture of your industry, of course, it's harder and harder to find high-grade deposits. If we look across your portfolio, how would you characterize the average grade of the mine?
So I would say typical with the industry average, which is around 1 gram per ton for those that follow the sector. But the important thing is we're in very large-scale operations with economies of scale. And so a great example of this are the two large open pit operations in Canada that we have royalties on, the two of the three biggest producing gold mines in Canada, which is Canadian Malartic and Côté. So they are large-scale open pit operations, heavily automated, economies of scale with large tonnage moved on a daily basis, which drives economies of scale. So these are big operations with well-capitalized operators that help mitigate the cost. But again, cost is not a concern for us. Costs can inflate, and certainly mining companies are not immune from cost inflation we're experiencing in the general economy. They face the same inflationary pressures that we all face on our day-to-day lives. But because of the nature of our model, the fact that we have top-line exposure, we're completely insulated from that risk.
Okay, terrific. Well, that's probably where we should close out. We're right at the end of our time. Thanks very much for joining us. A very interesting presentation, and everyone in the audience, thank you for joining as well. If we missed your question, I think I got to everybody, perhaps on a consolidated basis, but if we missed your question, please let your representative know and we'll track down an answer for you. Thanks again, everyone, for joining us, and we'll look forward to seeing you next time.